This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, so let's go through and start applying some of those rules that we saw on the previous page. Remember, there are two types of borrowing, specific and general. Specific borrowings are whereby you've taken out a specific loan, so one loan to fund one project. Whereby general borrowings, which we'll look at in the next video, is whereby you have, say, a treasury department in a large enterprise. They've got a pot of several different loans of differing amounts and differing interest rates. You scoop your hand in for your department to construct an asset using those borrowed funds. What rate of interest are we going to use? Okay, well, we'll need to work out a rate of interest to apply to the borrowings that we have taken from that pool of funds. Okay, so first of all, let's just look at specific borrowings. Remember the rules in terms of when the capitalization starts. So the capitalization starts when we are incurring the expenditure, when we're incurring the borrowing cost, and what was the third criteria? Flip back. Yeah, when the activities were taking place. So usually within an exam question, whether it's a multiple choice question, whether it's a longer written question, you need to look at the latest date, okay, because that will be when all of the criteria are being met. Okay, it's not a case of 1 from 3 or 2 from 3, all of them need to be met. So that's when we start. We end it when the asset is ready for use, not when it is being used. Okay, so you need to distinguish between those two dates. Yeah, when it's ready for use is normally earlier than when it is being used. And then don't forget, we temporarily stop the capitalization when there's no activities taking place, which would be when maybe there's a strike or bad weather. Okay, let's go. So it says here, calculate the amount of interest to be capitalized. So what are the borrowing costs capitalized as part of non-current assets if Colombia's reporting date is the 31st of December 2015. Okay. So what have we got? It says Colombia commenced the construction of an item of property, plant and equipment on the 1st of March 2015 and funded it with a $10 million loan. Okay, so we are going to go through there, aren't we? And start on, is it the 1st of March 2015, isn't it? Okay. The rate of interest is 5%. So we'll be applying the 5% to that 10 million. Okay. Due to construction, or due to a strike, I say, no construction took place between the 1st of October and the 1st of November. Okay. So what we're going to do is we're going to stop it, aren't we? From the 1st of October 15 to the 1st of November 2015, which I believe is that there as 1 month. Okay. Our year end is there as the 31st of December 2015. So what we've got to be careful of there is that we don't go through and capitalize from March through to December. So is that the, I think, 9 months? Okay. No, careful. 10 months, isn't it? Okay. So from the start, is it there to the end of the year? Is 9 months, but there's 1 month which we do not capitalize for. Okay. Don't be afraid to use your hands. 1st of March, April, May, June, July, August, September, October, November, December. Okay, 10, of which 1 month disappears off. So what we're going to go through and do there in terms of what is capitalized. In the year, it will be 10 million multiplied by 5% multiplied by 9/12. Tap that into your calculator Is that the 375,000? Okay. That answers the question. That's done and dusted as a separate party if you want, just to give you full coverage. What is going to be expensed in the year is 5%, but just for 1 month, isn't it? Okay, so what have we got? 10 million times by 0.05 divided by 12 is that there as 41,667. Okay, there we go. Excellent. So to answer the question, the amount that was capitalized was 375,000. So that will be added to the cost of the assets. It won't yet be depreciated, however, because we haven't yet started using that asset. Okay, remember we depreciate from when it is ready to be used. Okay, we're just here at the year end. Okay, so presumably this asset will be an asset under construction within PPE and will be depreciated at some point, maybe from when it is ready to be used, which I would assume would be next year. Okay, and then we've expensed, is it the 41667? So we capitalize it on the SFP and it is expensed in the statement of profit or loss. There we go. That's nice and simple. Any questions? Fire away on the Ask the Tutor forum.